Good afternoon, everybody, and welcome to this earnings call of LIC Housing Finance. From the management team, we have Mr. Vinay Shah, MD and CEO, and Mr. Sudipto Sil, Deputy CFO. I would request Mr. Shah to take us through the key highlights of the results, post which we'll open the floor for Q&A. Over to you, Mr. Shah.
Good afternoon. At the outset, I would like to extend a hearty welcome to all of you for this post-earnings conference call. As you would be aware, LIC Housing Finance declared its Q4FY18 numbers last Monday, that is 23rd. The key highlights of the quarterly results are as follows. Revenue from operations for the quarter at rupees 3,901 crore, up by 7%. Total loan disbursements, including loan to developers, for the quarter was rupees 17,402 crores, up 15% year-on-year, out of which individual home loans clocked disbursement of rupees 10,838 crores, a growth of 17%. Loan portfolio at rupees 1,66,363 crores, up by 15%. Net interest income of rupees 1,004 crores against 1,040 crores during the same period last year. Profit after tax rupees 539.33 crores against rupees 529.19 crores in the same period last year, a growth of 2%. Gross NPAs at 0.78% as compared to 0.43% over March 2017. Individual loan GNPA stood at 0.42%. Net NPA stood at 0.43% as compared to 0.14% as on corresponding date of the previous year. Dividend recommended at 340%. The quarter under review saw demand sustaining from previous quarter's levels. Overall disbursements for the quarter recorded a growth of 15%, with home loan disbursements at over 17% and was well spread out across geographies. Good growth was witnessed in the western, central, and in some locations in the eastern and southern parts of the country. Amongst the metros, we have seen strong growth at Mumbai, Pune, Hyderabad, and a pickup in NCR as well. Total disbursements for the year touched nearly 50,000 crores, showing a growth of 19%, with core home loan disbursement clocking a growth of 20%. In FY18, we had created two regional headquarters, one at Bhopal and another at Patna, covering states of MP, Chhattisgarh, Bihar, Jharkhand, and Orissa. It is encouraging to note that these regions have clocked growth rates between 30 to 40% during the year. At the post-Q2 concall, we had expressed our optimism in the affordable housing segment. We started showing signs of pickup in Q3 itself. During the fourth quarter, we have seen very good traction in affordable housing segment. About 12% of our incremental disbursements in the individual category were in the PMAY CLSS loan categories, rupees 1,819 crores out of rupees 15,136 crores. For the year, in terms of number of accounts, we have served more than 21,600 customers in this category, totaling over rupees 3,100 crores during the financial year, with nearly half the number, that is 10,300, coming in the second half of the year itself. In project finance segment, we have seen some signs of higher demand. During FY18, disbursements in this segment recorded a growth of 33% year-on-year and went up to rupees 4,266 crores from rupees 3,207 crores a year back. Post-implementation of RERA, we are beginning to see the new launches increasing gradually. Our approach to this segment continues to be selective on a case-to-case basis. The loan book growth continued to grow at a steady pace of more than 15% year-on-year. Individual loan segment growth was at 14%. The home loan book showed a growth of nearly 11.5%, highest in several quarters. As far as the composition of the loan book is concerned, retail home loans stood at nearly 81%. Project finance accounted for a little below 5%. The balance is comprised of other products like LAP, mostly to salaried segment, and LRD. Prepayment rates have remained stable. In the fourth quarter, there has been a sequential improvement in the overall GNPA as compared to Q3 levels. there has been no further additions of NPA in the project finance segment, whereas there has been an improvement in asset quality in the retail loan segment. The GNPA in the retail category continues to be one of the lowest in the sector at about 0.42%. Total provisions, including standard assets provisions, are nearly 96% of the gross NPA. Recovery efforts are in full force on the few delinquent accounts in the project finance side. During the fourth quarter, there has been a steep hike in the GSEC yields, with the benchmark 10-year GSEC climbing by more than 60 BPS one way throughout the quarter till about the last week of March. However, despite such increases, we have been able to achieve a decline in our overall cost of funds by a marginal 1 BPS during the quarter. Our incremental spreads continued to be around 225 BPS. During our interactions post Q3 numbers, we had indicated that margins have bottomed out. In Q4, there has been a sequential increase in the NIMs by 16 basis points over Q4FY18, and the NIM currently stands at 2.49%. The interest rate scenario continues to be quite dynamic, with significant volatilities through there. Have been a pause on policy rates by RBI. Keeping in sync with the interest rate scenario, we have increased the prime lending rate by 20 basis points this month, which should support margin recovery. Towards the end of Q3, we also conducted a review of the fee structure on different products and services. This has resulted in a higher fee income generation in Q4 by over 60% over the corresponding period of the previous year. This month, we have further increased fees across all product categories. This should assist in increase in the non-interest revenue. During the year, we started a number of initiatives in the technology space, especially in the area of cloud convergence and mobile application for channel partners to assist a seamless service delivery to our customers. Going into the new financial year, we are optimistic of the growth opportunities. For the year, we are planning to open 23 new marketing offices, which is nearly 10% of our existing branch network, and the highest addition in a single year in over 5 years. Most of the new offices that are proposed are in smaller centers, including Tier 3-4 locations in the states of MP, Chhattisgarh, Bihar, and Uttar Pradesh. With this introduction, I would like to thank you and welcome you once again to the conference call. I will now take your queries.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yes, sir. Particularly with respect to the growth on the individual side, so it's been slightly volatile in terms of the individual as well as LAP. LAP on a higher base has seen some kind of decline. But now, being almost like 15% of the portfolio, how do we see in terms of the overall LAP growth going forward? And even in terms of the project developer book, so is it more kind of a one-off, or maybe given post-RERA, we would look towards building up this portfolio?
LAP, LRD segment, as you said, the growth last year actually it was very good. So current year, if you compare it to the high volumes that were done last year, the growth translates into about 9-10%. For project, it's not a one-off case, number one. Number two, project, what we are seeing ahead is, as I have been saying throughout last year also, good projects we are open to. And post-RERA, some comfort has come to us also. And we will continue to have more of the growth rates and projects considered to this year also.
Okay. So will it be like a significantly higher growth given a very low base which we are having today and the opportunity which is there?
Last year, if you see the composition of our book, last year project had a share of 3.8%.
Yeah.
This has gone to nearly 5% this year.
Yeah.
And though our growth rate, you can say, in project is about 33% in disbursements.
Yeah. Yeah.
And the incremental growth, if you see in project, will be more. Incremental share, sorry.
Okay.
So that would be around, if I see, that would be about 8.5% of project for the year. But overall book share is about 5%.
And how about the resolution out there in the existing stress on the developer book? So what's like the best time?
Kunal, you're not clearly audible. Can you be a little loud, please?
No, so with respect to the resolutions on the stressed developer loan book, so when could we actually see something crystallizing out there?
I have burnt my fingers last year after this, I mean, around the same time when I had my first con call. I said one of the accounts will get resolved in Q1. But what has happened is it has still not got resolved because the money has in fact come to the court, and the orders can come even today or maybe. So we are waiting that I can't, today sitting here, I can't give you a firm date about it, but it can come. Regarding some other accounts also, we are in a fairly advanced stage of negotiations. I see that if not more than a couple of big accounts getting resolved by the end of Q2.
By the end of Q2?
Q2, yeah.
Oh, okay. And lastly, in terms of the fee income, so this is more sustainable since there has been structural rise across the products. So this is not much to do with the developer book build-up getting reflected in terms of the overall fee income pool.
Everything. Developer book also, individual also, we have rationalized it somewhat.
Okay. So then this maybe say, in FY19, on a base which is there in FY18, should we see a relatively higher fee income growth? Because that's maybe it was under pressure over the last 2 odd years. So should we say like that?
Yeah.
And,
it will be. Hello? Yeah, it will be fee income also. We are expecting that as compared to previous years, we will have a good growth rate. Good hike.
Okay. Yeah. Thanks a lot.
Thank you. The next question is from the line of Subhranshu Mishra from Motilal Oswal. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. Within construction finance, just wanted to understand what are the average ticket sizes and the number of deals that you've done in this year versus FY17?
See, current year in project finance,
right.
We did have the numbers. I'll just get back to you. It's total was 88 as against 73 last year.
Okay. And average ticket sizes, sir?
Ticket size would be 4,200 is the disbursement amount.
Right.
40 or 950 crores would be the average ticket size.
Right, sir. And just one more thing, sir. What percentage of this construction finance book is domiciled in the top 5 cities?
Nearly 70%.
Nearly 70%, sir. Sure. And one more data point question, sir. How would you split your home loan disbursements in terms of new sale, resale, and balance transfer?
See, out of 45,000 that we did, nearly, say, about 45% is new sale.
Okay.
And about 30%, a little less than 30% would be resale.
Right. Sure. Sure, sir. And could you help me with the prepayment rates that you've witnessed in the fourth quarter, sir?
Fourth quarter, in fact, it has gone down slightly, but not very significantly. So it still hovers around 9.8-10%.
And what was it in third quarter and fourth quarter of last year?
The third quarter was about 10.8%.
Right. And 4Q 17, sir?
417 was around the same level, 10.1, 10.2%. From that level, it has gone down.
Right, sir. Sure. And just one last question I want to squeeze in, sir. Given the RERA consolidation which is happening, do we expect a ticket size increase in the construction finance space going forward in FY19 and 20?
No, we would love to do it, but RERA actually, see, as you may be knowing, the full final shape of RERA has come up only in some of the states. So, even this AP Telangana side, the authority has not yet been set up, though they have passed it in the state legislature. But so overall, but yes, I do see that with the RERA coming in, the project comfort that we want also will be there, and it may translate into a better ticket size also.
Right, sir. Thank you so much for your time.
Thank you. The next question is from the line of Digant Haria from Antique Stock Broking. Please go ahead.
Yeah, what proportion of the new loans that we are originating are floating rate in nature?
Nearly, you can say that 85% or so is floating.
Okay, so sir, this is a significant change in strategy versus what, we've been following for, say, last 4-5 years. So now, for the next 2-3 years, should we expect that this margin volatility should come down because, LIC's margins have always been volatile and, we analysts try to predict it and only one thing is certain that will go wrong. So just wanted to know that, now should next 2-3 years be, a much more predictable regime as far as margins are concerned?
See, last concall, I think after Q3, I made mention of it. If we see the total overall, our book, so now nearly 75% is floating when we see the asset side. Hello?
Yes, sir, I'm there.
And liability side, if we see, it's about 78% is fixed. So now, with any, even a slight increase in the interest rates and getting it, making it account for our floating book, that is something which I see as a very good thing for us.
Right, sir. So, okay. So, yeah, I think it's fairly clear that, I think now we won't see such margin volatility and, maybe you will benefit once the rate...
As I said before, last year, we had brought down the PLR by 20 basis points, which was effective July 17. So now current month, April, we have again increased it by 20 basis points, the prime lending rate. So that will affect full back book as on date for the floating cases.
Right. Okay. So would FY19 be the year where your individual loan growth starts beating your overall loan book growth, because it's now almost 2-3 years that our individual loan growth has been lagging this, and probably we have been growing lower than even the system growth rate. So will FY19 be that?
I hope so, but this year also we have done it. Our the core loan, the pure retail loans, we have shown a growth rate of 20%, 20.4 to be precise. And overall growth rate is, if you see, only retail is 17.7 and total all disbursements is 18.8.
Right. So I was referring to only individual home loans, which is 11% YOY growth.
Okay. Fine. I was talking about the incremental disbursements. Overall, yes, it has been in the range of about 11%. Overall has been in the range of about, if we see retail, about 13.8%. So we will see that overtaking that may be tough, but then all efforts would be made to take it higher. And it will certainly go up, this is what we believe.
Right, sir. Thank you and all the best.
Thank you. The next question is from the line of Manish Shukla from Citigroup. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. The 20 basis points PLR increase in April, through the year, when does it flow through the 75% floating rate book? As in, does it get repriced in first half or it will be gradual throughout the year?
No, it will start right now, the first half only.
No, so of the entire 75% book, by what time?
Entire floating percentage of 70, yes.
So it will get repriced, let's say, in the first quarter itself?
Yes.
Okay. And can you tell us the exact changes that you did for the fee income in the previous quarter as well as this quarter in terms of the rates that you were charging earlier and what do you charge now? The fees part that you mentioned.
You were talking about the rewriting fees or the processing fee?
No, you said, right, that you increased the fees across the board.
Yeah.
So I wanted to get a
we have had a relook. Earlier it was 5,000 up to 1 crore and 10,000 beyond that. Now we have made it 0.25%, subject to maximum of 20,000 in one group and 50,000 in the other group.
And any changes on the project finance side on fees?
Project finance, as it is, it depends from proposal to proposal. That is defined the processing fees. Earlier also it was not there, but there also we have, internally we have tried to rationalize it. And instead of having ad hoc charges whereby our regional managers were able to finalize things, most of the things are coming to us and we see that we take at least 0.5% or something in, it depends on case to case. In fact, last year what we have very consciously done is focusing on these processing fees and rewriting fees and other things.
And fees on LAP are similar to retail or they are different?
Can you repeat, please?
Fees on the LAP book, loan against property, is that same as retail loans?
Yeah.
Okay. Then on project loans, as you said, your comfort for doing project loans probably goes up post-RERA. I'm assuming that would be trend for the most lenders. Do you believe that will bring down the yields in that segment more relative to what you are doing right now? So, for example, let's say the spread between project finance and retail is roughly 400 basis points today. Can that spread narrow because of competition?
No, see, the competition more or less defines what rates are finally offered to the developer. So, post-RERA, I don't see it getting much affected here. It will continue to be the same thing, but...
Okay. Your mix has changed in favor of project loans and loan against property, yet your incremental yields have declined. What would drive that? Incremental yield last year was 10.8. This year is 9.8 on a full year basis. Despite a big shift in asset mix towards higher yielding assets.
No, see, that has, if you see it from this comparison with last year point of view, yield is whatever we are getting is during this particular rate. It's not that last year we did too much of project and other things. Number two is that last year, if you remember, sometimes in the month of June, we brought out that 8.35% lending rate product.
Right.
So that also had effect on this.
But at the same time, your LAP loans and your project loans should get you much higher yield, right? So on a blended basis, why is
but that share has not gone up. You see, that share has not gone up that drastically.
Okay. Right, sir. Last question. For the quarter, can you divide the individual disbursement between retail and LAP, home loan and LAP? Q4, yes.
Retail was, pure core was 10,000, as I said in my opening remarks also, it was 10,838 crores.
Right.
Project was 2,266 crores. And LAP and other things were 4,200 crores also.
Understood, sir.
Total was 17,400.
Thank you very much. Those were my questions.
Thank you. The next question is from the line of Dhaval Gada from Sundaram Asset Management. Please go ahead.
Yeah, thanks, sir. Just one question. Can you share the incremental yields on individual home loan, LAP and developer for the quarter?
Actually, if you see the individual loans, the incremental yield has been in the range of around 8.7 and this is the core. That is the pure mortgage home loans. For the builder loans, it is around 13.
Okay. And LAP was?
LAP was around slightly less than 11, 10.7 or thereabouts.
Okay, so broadly unchanged from last quarter.
Yeah, there has been no reduction in the pricing in Q4.
Okay, thanks.
Thank you. The next question is from the line of Sangam Iyer from Shubhkam Ventures. Please go ahead.
Yeah, so just wanted a small clarification first. Did you mention in your earlier remarks that you're looking at the project mix moving to 8.5% of the overall loan book?
No. I said that incremental, if I see only for the year disbursements, so project constitutes about 8.5%.
Okay.
But overall book has gone up from 3.8% last year to about 5% this year.
Correct. So is this the current mix that we are seeing of 81, 5 and 40? Is that the kind of mix that you would see in the next year's loan book as well with the growth coming in?
Yeah. We are quite focused on project also.
So what's the kind of overall growth that we are envisaging for the next financial year, sir?
We are starting with the basic premise. Last year also we started wanting a 15% overall growth. So we will again stick to that only for the time being.
Wouldn't the base effect of, the headwinds that we had last year because of RERA, etc., now that that's been behind us, wouldn't that actually have provided us as a tailwind in terms of incremental projects and incremental approvals coming through, which could actually help us grow beyond the 15%?
No.
Given the base effect?
No, definitely. As I said, probably, this is what we started. We incrementally also we had targeted a 15% growth rate for disbursements. There we landed overall at around 18.8%. And if you see the back book growth, overall it was 15.1%. And there the core also was 11.2%, which again is one of the highest.
Okay. So, sir, just a small question on the fee hikes that you have taken across the product categories. Given that predominantly all the banks whose retail-focused banks, etc., are actually looking to increase the housing loan component in a significant manner, and the differentiating factor could be the processing fees or the yields that are there over here. So, in such a scenario of hyper competition that is kind of building in the system for the retail pie, how do you see the passing on of this incremental fee hikes that you have taken?
This revision we have done after taking into consideration the same that is existing in the current market by all competitors, banks. Earlier, actually, what we found out was that probably we were missing out this aspect. We were not very particular about review of the rates had not happened for practically a very long period of time. Now, most of the banks, if you see, as on date, are charging upwards of 0.25. Some of them are charging State Bank. In fact, I should not name it, but they are charging 0.35. Some other banks are also charging 0.50. So we have tried to rationalize it somewhat. So I don't see that the hike is number one is too much for the customers, and they're quite reasonable, and they will be accepted by the customers.
Okay. And do you see any further pressure on your overall yields, going forward incrementally? Because the assumption being that the MCLR rates do not go further. Because if that goes up, then obviously the pressure eases off for you on the yield front.
No, as I said, prime PLR we have already increased from April by 20 basis points. So this will affect that 75% of our floating book. So yields are bound to go up.
Got it. Okay. Great, sir. I will come back to the queue.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Nishan Shah from Macquarie. Please go ahead.
Hi, sir. One quick question on your fee income. Could you give us a split of the fee income? What percentage is core fee income? What percentage is any insurance cross-sell if you are doing anything?
No, insurance cross-sell, nothing.
Okay. May I ask why not? Like, do we have plans to enter into any relationships with other insurance companies if LIC does not have a suitable product?
No, we had a product on that line which was not doing well, and probably because of the higher amount of EMIs it translates into. So currently we are looking into a product, but that will come only if we get through a suitable one.
Okay, sure. And just one quick question on your cost of funds. So incrementally, for FY19, what could be your cost of funds? I think we exited the quarter at about 8.3. What would be the incrementals for FY19?
That is not the incremental, Nishant. That is actually...
Yeah, that's a weighted.
Incremental was 7.55
for the year.
Correct. So 7.55 was incremental for last year. Anything on FY19?
I think FY19 by and large it should remain around this level. There could be, it depends upon the RBI policies, but as of now it appears to be remaining stable at this level.
Oh, okay, thank you so much.
Thank you. The next question is from the line of Prashant Poddar from ADIA. Please go ahead.
Hello.
Prashant, your line is unmuted. Please proceed with your questions. As there is no response, we will move to the next question from the line of Aditya Jain from CLSA. Please go ahead.
This is Prakhar. I just wanted to take some clarity on, what is the stock of your existing borrowings that will come up for maturity in FY19, and what would, as of now, what would have been the cost of those borrowings?
I think around 21,000 or so, and would be 8.4, 8.5.
And in April or May, what would have been the cost at which you have raised incremental funding?
Yeah, as of now, April, I think we have just done about a couple of small CP issuances, and they have come at the ballpark around 7.3.
Okay. So, do you think on this 21,000 crore repricing, there is a possibility that even with the rate hikes, you will be able to raise at lower cost?
Yeah, looks likely, because 8.52 is the contracted rate, and as matters stand now, we should be in a position to raise it, kind of fund it at lower than 8.5.
Okay, thanks. In terms of the NPL side, you had mentioned in your opening remarks about the corporate account, which is where the courts have received funds. But it is due to come. Could you just remind us about what is the quantum of this loan and what is that is holding back the payment coming to LIC Housing Finance?
See, it is around, the principal outstanding is around 42 crores, around 40 to 42 crores, and we are expecting that not only we will collect the principal, but also at least 25-30 crores of interest on that. And that account is 100% provided.
Okay. And, in your NPL classification, about 660 odd crores is the individual NPLs. How much of that would be on LAP and how much of that would be on housing loans?
Housing would be in around 525 crores. Balance is 135 is LAP.
Okay, and the LAP book features haven't really changed, right? You were doing small ticket loans to existing customers for really long period of time. Has the base feature sort of changed with very low LTVs?
Yeah, LTVs continue to be quite low, and the basic type of borrowers remain the same. Service class, mostly service class.
Okay. Thank you so much.
Thank you. The next question is from the line of Banti Chawla from B&K Securities. Please go ahead.
Thank you, sir, for giving this opportunity. Just one quick question. Your incremental spread has come down to 2.25%. So can we expect this to increase in Q1 FY19?
Yeah, actually, the incremental spread had come down partly because of the sharp rise in the borrowing cost in the fourth quarter, where you would see sequentially the cost of borrowing has gone up by almost 20 basis points.
Okay.
But post last week of March, there has been some revision in the cost of funds. And also, as our MD mentioned, we have increased the pricing on our products. So that should ease the, help improve the incremental spreads.
Okay, as you said, the borrowing cost has increased, but we observe that Q1Q basis, the margins has improved by 16 bips, although incremental spreads or
spreads because of collections, etc.
Sorry?
That is because of higher levels of collections.
Higher level of collections. Okay, that is the major reason for that. Okay, so can we say that 2.49 kind of a thing, can we expect the similar margin in Q1 as such?
Yeah, right now if you look at it, we will get a substantial benefit from the increase in the PLR, which will cover almost 70-75% of our loan book. So that itself should help us in stabilizing the margins. But
incrementally, Q1, the cost of funds might also increase similarly, no?
As of now, it doesn't look like.
Okay.
As of now, it looks like the incremental cost might be slightly lower than the Q4 levels.
Okay.
We have to really wait and see about what happens on the bond market. With a lot of volatility is also coming in of late. And especially currency volatility which has come in the last few days, we'll have to see.
Right. And can you give you any internal targets for developer funding as the portfolio has increased from 4% to 5%? Any incremental targets, internal targets for this to reach 6%, 7% or 8% next 2 to 3 years kind of a thing?
No, as I said before also, I mean, we are open to going aggressively into the project loans. So at the most, I mean, percentage-wise, it will not very increase drastically. But yeah, we are showing, looking towards a share of maybe 1 or 2% more.
Okay. Thank you, sir, for that.
Thank you. The next question is from the line of Rahil Shah from Ambit Capital. Please go ahead.
Yeah. Hi, this is Pankaj here. Sir, my question is on your rates where you said that you have increased your PLR by 20 basis points. But if I check your rates on your website and all other home loan websites, it's still at 8.35. So is it...
PLR affects the back book, the existing loans, and product internal changes. What we have done is, again, that the 8.35 I can share with you, it's a teaser kind of a rate, which is now applicable. Earlier it was applicable to women borrowers under 30 lakhs. Now it is applicable to women borrowers under 10 lakhs.
Okay.
And the second line, which we were having at 8.4, that we have increased to 8.45. So these are the product actually remains the same, but the rates given therein have been changed. So that 8.35 will, for publicity purposes, it will remain like that.
So if I understand it correctly, you have not raised the rates for new borrowers, right?
We have. That's what I'm saying.
Pankaj, I think you have not... see, what we mentioned is that earlier the 8.35 was available only for loans up to 30 lakhs with special conditions. Ladies. Now it is available only for 10 lakhs. So if you look at it, there has been an increase for loans above 10 lakhs up to 30 lakhs also. That falls into the next category. It's a reclassification of the various slabs.
That we were giving at 8.4, now we are giving that at 8.45. And beyond 30 lakhs, now we have increased it to 8.50 also.
Yeah.
Now my question is that now you have raised rates for old borrowers and the market rates as well as your rates for new borrowers have only increased by 5 to 10 basis points. Don't you think your prepayment rates will go up drastically because of this?
No. Actually, it will not, because the differential between the back book and the incremental rates have come down. Over the last 1 year, if you see, post our reduction in the PLR and subsequent huge amount of repricing which happened on the book, if you see on the back book, the weighted average yield on the back book right now is much closer to 9%, which was in the range of around 9.6 to 9.7 about a year or 15 months back. So the gap between the incremental lending and the back book has narrowed down to the minimum in the last 3 years now. It is the minimum of the last 3 years.
And do you think this gap will further narrow down?
See, if there is a further increase in the lending rates in the system, then again a re-rationalization will happen.
Okay.
But most of the, post-demonetization, when the rate of interest had actually come down, there was a lot of prepayments and repricing which happened on the back book.
Okay.
So that itself has reduced the gap.
Okay. Okay. And, sir, you are increasing your disbursement in developer loans, but if you see your past experience, you have one of the highest NPAs in this particular loan book, compared to your peers, right? So have you changed your procedures, systems, anything, to grow at such a high pace?
We had a relook into our full SOPs. The developer loans with us only, whichever have gone into NPA, we have no issues as far as the securities are concerned. So that may take some resolution, may take some time, but we are very positive that it will not become a case of writing off later on. And all the loans have been provided for fully.
The other thing is that, Pankaj, if you look at the overall numbers, see, at present we'll be having around 220 to 230 live loan accounts, out of which around 5 or 6 are the really the big delinquent ones, which themselves account for almost 70 to 80% of the total gross NPAs in the project side. So it is not to say that the underwriting capabilities or the underwriting quality is not good.
Okay. And finally, your retail NPAs, they've almost doubled year-on-year basis. Though in absolute terms still they are low, but if you look at last 10 to 11 year trajectory, after 10 years of continuous improvement, this is the first year you have seen the increase in NPAs here. So anything changing here? I mean, is it because of external environment or your product mix shift? I mean, any color on this?
So mainly because of, such things happening everywhere. We did experience some pressure on this front, but again, it's something which is manageable. In fact, last year only, sometimes in Q3, we created a separate set of people in all our offices to be aggressively after it, and you see that we have at least reduced from the December levels, Q3 levels, as far as even the core NPA goes. And going ahead also, probably we are looking at these NPAs also coming down substantially.
And to answer your other part of the query regarding the composition, we just a few minutes back shared the NPAs on the various segments. There the experience on the home loan side and on the non-home loan side is almost identical.
Okay. And last one, you said that 12% of your incremental disbursements are coming from affordable housing, right? That PMAY scheme.
Correct.
Yeah. Now, what I've heard is that what industry has disbursed under this scheme in last 3-4 months, the subsidy is not coming into the accounts.
No, that's not the case with us.
That's not the case.
No.
Okay.
We have filed for, and apart from those cases where there are some requirements, some further data is to be given, some data inconsistencies, we are getting subsidy.
Okay. Thank you very much, sir.
Thank you. The next question is from the line of Umang Shah from HSBC. Please go ahead.
Yeah, hi. Thank you for the opportunity. I just have one question. Our OPEX this quarter has gone up about 52% sequentially, and the cost to income has also crossed 20%. Is there any one-off in the employee or the other expenses, or this is just a normal business expense?
See, it is partly, it's actually a normal business, and the cost to income right now is maybe around 17-ish. We always try to maintain between 15 and 16. So there is a small uptick, but mostly it is in line.
Okay, so ideally, would it be fair to say that on a full year basis, it should remain about 16, 17, and intermittently during particular quarters, we may see some volatility?
See, I would feel that the range should be between 15 and 16.
Oh, okay. All right. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Yeah, hi. Just one question from my side. In terms of the recoveries that you're looking at on the developer loan book, are these more of recoveries from developers, or is it kind of more of a transfer or loan taken over by somebody in competition?
No, the resolutions you are saying?
Yeah.
The resolutions?
No, once, the resolution will come from the developer mostly.
Yeah.
Okay.
Takeovers usually don't happen once the project becomes NPA.
Mm-hmm.
So takeovers usually don't happen. 99.9% that won't happen.
Sure. And just wanted to get the NPL number. You said NPA in pure housing is around 525 crores.
Yeah.
And around 140 in LAP.
135.
135. Okay, great. Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah, so one more question. Broadly, in terms of the overall growth, if we look at last 2-3 years or say 10 quarters, be it in terms of the individual loan, including the LAP, we had been at around 14-odd%. Even on the pure home loan, say we are at almost like 13-14%. So there is a clear loss in the market share when we compare it with the industry as such. And when we look at our peers, in fact, everyone has been growing in phases. So maybe like few of the players are active, they are growing at more than 25%. So given the funding cost advantage, branding, everything, at any point in time, would we look at, say, growing higher than the industry average? Because there are opportunities, other players are doing it, they are also maintaining the overall asset quality at a similar level. So what would take it maybe in terms of getting relatively more aggressive and trying to get the market share, but not at the cost of profitability? So we have not seen any kind of impact on their profits as well. So when does that stance change, or what would it really take it to for that kind of a change in strategy?
Now, current year, we are looking at growth rates which should be better than the industry growth rates, number one. Number two, as a matter of strategy, I made a mention in my opening remarks is that the first thing that we are doing is opening of 23 new marketing offices. Now, that will increase our spread also. That will bring in more numbers. And out of these 23 marketing offices, some 6 or 7 are at centers where we already have a branch. But all rest are at Tier 2, Tier 3 cities where we don't have a physical office presence. So this is intended to do that. Number two, we are also thinking in terms of having a new vertical which is equivalent to a direct marketing sort of a vertical, which is in a very advanced stage of implementation. Maybe by the end of Q1, it will be in place. So that also we are attempting to see that we get more volumes and growth rates are matching the industry growth rates.
Okay. And anything on the self-employed side, because there is huge opportunity out there as well. Okay. So are we looking at on the self-employed?
No, we are doing those loans. I mean, it's not that we don't do it at all. If we see amount-wise, still about, you can say 75 or 76 is our salaried. Incrementally, if you see, 76 would be about salaried class, maybe more also. And about 12% we are doing from this group also.
Okay. So within the individual, it would be 75, 50?
More than 75.
Okay.
More than 75, yeah.
Okay, but 12% is coming from self-employed?
Nearly 12%, yeah.
Okay.
It is business and self-employed, that segment as we have categorized.
And this is apart from the LAP entire thing?
No, I'm talking about total book.
Okay.
Yeah.
Okay. So we should see a relatively higher growth this year onwards, maybe, compared to the industry at least. Okay, good.
Thank you. The next question is from the line of Nitesh Jain from Investec. Please go ahead.
So my question is on incremental yields that you mentioned that on housing loan incremental yields are 8.7%. What are the incremental yields for the month of April, and are these yields annualized or are they mentioned on card rate basis?
See, as far as the yields in April are concerned, April yields will be slightly better because we have revised the rates in April itself, second fortnight of April especially. It will be maybe around 10 basis points higher.
And this 8.7% is annualized yield or it's on card rate?
7 is the 8.7 incremental for the year or yes, last year? What you are?
For last quarter, you mentioned that home loans incremental yield is 8.7%.
Yeah, so that is not annualized.
That is not annualized. Okay. Thank you, sir.
Thank you. We have the last question from the line of Ritika Dua from Elara Capital. Please go ahead.
Yeah, so just two questions. So firstly, if you can again repeat the disbursement mix between individual and LAP. And the second question is if I could get the interest right back for this quarter.
Disbursement do you want for Q4, huh?
Yes, so just for the quarter.
Yeah. Core is 10,830 crores, 38 crores. Non-core is 4,298 crores and project is 2,266 crores.
And sir, if you don't mind,
this 17,402.
Sure, sir. And then if you don't mind, this number last year, same quarter was, if you can also share.
9,200 was core. 4,700 was non-core. And 1,232 was project.
Thank you, sir. And just the last question on the interest right back.
Sorry?
Interest right back this quarter.
Can you repeat it?
Right back,
So you said that you had recoveries, so
the recovery from write-offs, that will be around 3 or 4 crores, not much.
Okay. Yeah, so that's it from my side. Thank you.
Yeah.
Thank you very much. That was the last question. I now hand the conference over to the management for their closing comments.
Well, thank you very much to all of you for participating. As I had said at the end of Q3, probably as far as the NIM margins were considered, they were at the lowest. They will go for upside. They have gone for upside, and we will continue working to see that they improve in the coming quarters. Disbursements, Q4 disbursements were one of the highest. If we don't see only growth, but if we see the volumes, in fact, 17,400 is the best ever disbursement in any quarter for our company. So that is also an upsurge. We will continue to do it. Projects also, Q4 was very good for us. We did 2,200 odd crores under projects, which showed a growth rate of about more than 80% in that also. So there also, projects will contribute a good amount in the coming fiscal also. Thank you and all the best to all of you also.
Thank you. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference call for today. Thank you for joining us, and you may now disconnect your lines.